welcome to the deep dive. You've given us a really interesting set of materials to chew on today,
Yeah, quite a bit here.
especially this September 2023 stocks or bonds.pdf report.
Yeah.
It's packed with analysis looking at the economy, where it might be going, and what that means for investing.
Mm-hmm.
So our goal with this deep dive is really to cut through all that info and, to try to nail down the core arguments. Should we be leaning towards stocks or bonds right now, based on this analysis?
It's the fundamental question, isn't it? And what immediately struck me reading these sources is just how much disagreement there is out there.
Right.
I mean, that point in the intro about the Wall Street strategists, the widest gap in their S&P 500 target since 2002, that's a huge red flag. Signals real uncertainty.
Definitely. And it's not just stocks, is it? The report says the same kind of disagreement exists for interest rates and bond prices, too.
Exactly. There's just no clear consensus, which sets things up nicely for a real clash of perspectives.
Okay, so let's dive in. First big theme, the bearish argument against bonds. Bill Dudley's piece in Bloomberg back in June 23 seems key here. He argues U.S. Treasury prices have further to fall.
Yeah, Dudley makes a pretty compelling case. It sort of rests on a few main pillars.
Okay.
First, he sees the U.S. economy as surprisingly strong, despite predictions. Tight labor market, inflation's still stubbornly high.
Hickey, yeah.
Right? So because of that, he thinks the Fed just won't be able to ease up on rates. In fact, they might need to go higher and stay there longer.
And the Fed's own projections at the time seemed to back that up. More hikes, rates above 4% into 2024.
Precisely. Those FOMC projections really supported his view that higher rates might be sticking around for a while.
Okay, so Fed policy is central. What else is driving Dudley's thinking?
Well, he also brings up this interesting point about the Fed maybe raising its estimate of the neutral interest rate.
Ah, the neutral rate, the sort of Goldilocks rate, not too hot, not too cold.
Exactly. If the Fed thinks that rate is actually higher now, it implies they'll need to keep the policy rate higher just to keep inflation in check. That means, higher borrowing costs generally.
Makes sense.
And beyond that, Dudley points to some bigger sort of structural shifts in the economy.
Like what? What kind of shifts?
He highlights a few things. Demographics, baby boomers retiring, spending down savings. Then you've got these massive government budget deficits, huge borrowing need there.
Right.
Plus big investments in things like supply chains, green tech. Dudley argues all this increases the demand for borrowing relative to savings. Basic supply and demand, really, pushes rates up.
So it's not just the Fed's immediate actions, but these deeper economic currents, too. And he mentioned the Fed's 2% inflation target.
Yeah, he argues that even if inflation comes down, the average inflation over the long run is likely to be higher than 2%.
Why is that?
He points to the Fed's sort of asymmetric policy. When inflation's low, they aim a bit above 2%. When it's high, they just aim at 2%.
Ah, so it creates an upward bias over time.
That's his view, which isn't great for bonds because investors demand higher yields to compensate for expected inflation.
And he wasn't shy about linking this to government spending, was he?
Not at all.
Yeah.
He explicitly fingers the Biden administration's fiscal deficits as a key cause of the inflation we're seeing. Directly supports his argument about government borrowing pushing up rates.
Okay, which leads us straight to that Wall Street Journal editorial from August. Washington stages a peacetime fiscal blowout. Sounds like it echoes Dudley's concerns.
Oh, definitely. The WSJ piece paints a really worrying picture. Huge deficits, even without a major war or crisis.
What were the numbers again? $1.62 trillion deficit in just 10 months.
Yeah, staggering. A massive jump from the $726 billion the year before. Even adjusting for timing issues, it's a huge increase. And the really alarming part is the cost of just servicing the existing debt.
The net interest payments, $572 billion. Nearly double corporate tax revenue. That stat really jumped out.
It really does put the scale of the debt burden into perspective, doesn't it? And as the editorial points out, that was mostly before rates even peaked.
Wow.
Plus, they mentioned the plan to issue another $1 trillion in new debt at these higher rates. That just makes the interest payment problem worse down the line.
Not a sustainable path, it seems.
The editorial basically says it's hard for the U.S. to lecture anyone on fiscal responsibility right now.
And then there was that BOFA projection, the one about how fast U.S. debt is growing.
Yeah, that calculation. U.S. government debt increasing by $5.2 billion a day? for the next 10 years.
Good grief.
It just hammers home the sheer size of the challenge, really reinforces what Dudley and the WSJ were saying. It's hard to even wrap your head around that number.
So the bearish case for bonds is really built on this idea of persistent inflation, higher rates, driven by the economy, Fed policy, and these, well, frankly, terrifying deficits. And then Larry Summers weighed in, too.
Exactly. Summers, in that Bloomberg interview from July 23, he also warned against getting complacent about inflation just because it dipped.
Right. Don't celebrate too early.
Precisely. He predicted bonds would sell off further because the market hadn't fully grasped how much more the Fed might need to tighten. He felt getting back to 2% inflation would require more economic pain.
And he wasn't afraid to say what that pain might involve.
No, he wasn't pulling any punches. Summers suggested the Fed would likely have to actually induce an economic downturn. A recession?
A recession, wow.
Yeah, to really crush inflation back to that 2% target, which implies, maybe even higher rates first, then a significant slowdown. Not necessarily great for bonds in the lead-up, though maybe a temporary flight to safety during the recession.
And Bill Gross, the bond guru, he had a similar take.
Yes, Gross. On Bloomberg TV in August, he said 10-year treasuries were overvalued at the time.
What yield did he think was fair?
He suggested around 4.5% compared to the roughly 4.16% they were yielding then. So again, the idea that yields could rise more, meaning bond prices could fall more. Yeah. The market might not have priced it all in.
Okay. The report then takes this historical detour, comparing the 19th and 20th centuries. Why is that relevant for us today, thinking about stocks versus bonds?
Well, it provides some really important context, I think. The 19th century U.S. strong growth, sure, but crucially, not much inflation. Very little government debt.
Right.
Fast forward to the 20th century, huge run-up in government spending and debt, much more monetary inflation, and maybe most relevant now, those disappointing real income gains after the 1970s.
So the parallel is, we might be in another inflationary era, like the later 20th century, where real gains are harder to come by.
That's the suggestion.
Yep.
The link between that monetary inflation and weaker real wage growth is potentially concerning. Makes you wonder if inflation will keep eroding the real value of our money and investments.
Which brings us right to that trend the report highlights. Weak, real personal income growth since the 70s. Driven by monetary inflation, it argues.
Basically, yeah. Nominal incomes went up the dollar amount, but purchasing power, what you can actually buy, didn't keep pace because prices rose so much. The report even mentions that if you use the shadow stats inflation calculation, real wages might have fallen way more, maybe even 50% over decades.
50%. That's staggering.
It's a really sobering thought, isn't it? Especially when you're trying to build wealth over time.
And the John Burns study supports this idea of diminished affordability.
Yeah, that study looked at how hard it is for young people now to hit those traditional adult milestones, moving out, buying a home.
Right.
The report uses it as evidence that the cost of living has just outstripped income so much that financial independence is way harder for younger generations.
And that Gen Z credit card debt stat, jumping 52% year over year.
Exactly. It suggests real financial strain, people relying more on credit just to get by.
Okay, so the picture is inflation, maybe even understated inflation, is eating away at purchasing power, making it harder to get ahead financially. What's the outlook for real wages going forward?
Well, the bank credit analyst makes a key point. They say nominal wage growth paycheck increases needs to stay pretty high just for real wages to get back to their pre-pandemic trend.
Just to catch up, basically.
Right. So even if you get a raise, your actual buying power might not be improving much if inflation stays up. And for real wages to actually increase significantly, nominal wages would probably need to accelerate even more.
Which could just fuel more inflation, right? Leading the Fed to hike more.
Exactly. It's a potential negative cycle and not good for bonds if it means higher rates.
And now Ferguson and Larry Summers had thoughts on this wage inflation dynamic.
They did. Ferguson notes average hourly earnings were growing around 5.1%. Plus, you had big union demands, Teamsters, UAW. He quotes Summers saying that level of wage growth just isn't consistent with getting back to 2% inflation.
And Summers' solution was?
A significant economic slowdown. You can't curb that kind of wage pressure, he argues, without cooling the whole economy down.
So, tough medicine required. What's the alternative scenario?
Well, the report also mentions the possibility that nominal wages just stagnate, don't keep up with inflation. That would depress real wages further and could lead to economic contraction anyway. So either way, the outlook for real wage growth looks pretty challenged.
Okay, so we've built a strong case for being bearish on bonds, persistent inflation, Fed action deficits, wage pressures keeping rates high. But then the report shifts. It starts looking for signs of economic weakness. That could argue for being bullish on bonds, couldn't it?
This is where it gets really interesting, and yeah, the picture gets more complicated. The report brings in analysis from Eric Basmajian at EPB Research, work highlighted by folks like Albert Edwards and Gerard Minack.
What are they looking at?
They're focusing on the indicators the NBER uses to actually call recessions. And what they find is, while the jobs data still looks okay,
Still robust, yeah.
a lot of the other key indicators are flashing warning signs, like the average of GDP and GDI, gross domestic income. They look recessionary.
And GDI is sometimes seen as a better real-time indicator than GDP, isn't it?
It often is, yeah. And the report emphasizes that GDI plunged in Q1 and Q2 last year, even while GDP was still positive.
So Basmajian's conclusion is,
Pretty stark. He thinks a recession might have already started, even if it's not obvious in the jobs numbers yet. That's a really important counterpoint to consider. The economy might be weaker under the surface than headlines suggest.
and that weakness isn't evenly spread. The report mentioned declining real incomes for certain groups.
Yes, it points out real incomes falling for lower-paying jobs, and especially for Black or African-American workers. It suggests the economic pain is hitting some groups harder already, which can often precede a broader slowdown.
Now, we have seen CPI moderate a bit recently, but the report says the overall level of prices is still way up.
That's a crucial reminder. Even if inflation rate slows, the cumulative effect of years of higher prices means the cost of living is still way higher than pre-COVID. That burden is still there, weighing on consumers.
What about market positioning? How are big players like hedge funds positioned in bonds?
The report notes a large short position in Treasury futures among hedge funds around that time.
Meaning they were betting bond prices would keep falling.
Exactly. Betting yields would rise. It shows a strong prevailing sentiment among some sophisticated investors, aligning with that bearish bond outlook we discussed.
And the sentiment indicators comparing stocks and bonds.
Really striking divergence there. Jason Gopfert observed record-high optimism in stocks compared to bonds.
So bullish stocks, bearish bonds.
That seemed to be the mood. And JP Morgan noted commodity trading advisors also held a big, like, $150 billion short bond position. Again, widespread bearishness on bonds among certain investor types.
Yet, this stock market optimism seems really out of sync with how people on Main Street were feeling.
That's a critical disconnect, that CBS poll. 2/3 see the economy as bad, 70% feel paychecks aren't keeping up. That paints a much bleaker picture than the stock market vibe.
Right. More people living paycheck to paycheck, too.
Exactly. It highlights the financial strain many households are under. But paradoxically, Deutsche Bank observed investors were actually increasing allocations to risky assets like stocks. It's a strange tension.
Okay, so we have this disconnect. Public feeling stressed, markets getting riskier. Now let's flip the coin. The bullish case for bonds. Peter Bookvar brings up global manufacturing weakness.
Yes, Bookvar points to weak PMI data across Asia, China, South Korea, Taiwan, Japan, others.
PMIs being.
Purchasing managers' indexes, key gauges of manufacturing health. They were showing contraction in output, new orders, export sales.
Why the weakness?
He puts it down to slowing global conditions and businesses still holding too much inventory. The mention of Taiwan expecting further production cuts is worrying, given their role in tech supply chains.
So weakening global manufacturing could signal a broader slowdown spilling over to the U.S., making bonds look safer.
That's the potential implication, yes. A flight to safety could benefit bonds.
And we saw actual export numbers dropping, too.
Absolutely. Indonesia reported a sharp drop. Laura Curtis at Bloomberg highlighted China's biggest export contraction since early 2020. Germany saw a big decline, too. It points to weakening global trade flows.
And the risk is this weakness in Europe and China spreads to the U.S.
Yes. JP Morgan economists Lepton and Kasman flagged that specific risk. And the report lists other worrying signs. India's exports plunging, Taiwan's 11-month slump, Vietnam's longest slump in 14 years, Canada in deficit. It all paints a picture of a weakening global backdrop.
Which could definitely boost the case for holding bonds, right?
Potentially, yes. If investors anticipate a significant global slowdown impacting the U.S., demand for safer assets like treasuries could increase.
The report also talks about shifts in global trade patterns. What's changing there?
This is really fascinating. Mexico overtaking China as the top exporter to the U.S. That's a huge shift. China's now third.
Wow. And China's shipments are down to other places too.
Yeah, down significantly to the US, South Korea, Japan, the EU, Australia. But interestingly, shipments to Russia surged.
So trade tensions, supply chain shifts, geopolitics all playing a role.
Seems like it. A real reshaping of global trade flows.
And the drop in foreign direct investment into China adds to that story.
Yes, that sharp contraction suggests cooling investor sentiment towards China. Could be economic worries, geopolitical uncertainty, maybe companies rethinking investments if export markets are weakening.
What about those weirdly high export numbers from the EU to places like Kyrgyzstan?
The report cites analysis suggesting that's likely Russian demand being rerouted due to sanctions, goods going through intermediaries.
Ah, makes sense.
But despite those specific flows, the overall global container trade picture, according to Maersk, was still pointing down, a 4% contraction predicted for 2023. So broad weakness.
Okay. An HSBC economist May Trade Das connects this back to the impact of high rates and inflation on consumers.
Right. Das emphasizes that higher rates and sticky inflation are eroding real incomes, especially in developed economies like the U.S. Figure 21 shows this clearly. Nominal wages up, but real wages, what you can actually afford, falling behind.
And less real income means?
Less demand for goods and services. People just have less money to spend, which could squeeze company revenues and profits.
This decline in real income obviously hits GDP growth and consumption hard.
Absolutely. Consumer spending is a huge driver. And the report highlights the housing affordability crisis, too. So many homes over $1 million, high mortgage rates, high rents.
That Redfin stat about teachers.
Yeah, the collapse in teachers able to afford homes in their district, it really underscores the pressure on many essential workers and the broader affordability issue.
And people burning through their pandemic savings adds another potential headwind for spending.
That's right. Those excess savings provided a buffer, but estimates suggested they'd be depleted by Q3 last year. Once that cushion is gone, spending likely gets much more constrained. A potential day of reckoning, as one headline put it.
Then the report brings in some classic recession indicators. The leading economic index.
Yeah, the LEI had fallen for 16 straight months. That's a pretty strong warning sign.
And Professor Estrella's model.
Put recession odds at 99.82%. Very high. Plus, David Rosenberg noted the typical lag about 2 years between the first rate hike and a recession. And we were seeing negative global earnings revisions, all pointing towards a slowdown.
Jeffrey Sherman at DoubleLine saw recession signals too, and expected the Fed to react how?
Sherman believed multiple indicators were flashing recession. He expected the Fed would eventually have to cut rates significantly, maybe 100 basis points, to combat the weakness.
Which would be bullish for bonds.
Generally, yes. Expectations of rate cuts tend to push bond prices up.
Daniel Park's blog, Juggling Dynamite, mentioned the inverted yield curve.
Yes, another classic recession signal. Short-term yields higher than long-term yields.
Why is that significant again?
It suggests investors are more worried about the near term than the long term. Park highlighted Sherman's view that this inversion signals the market thinks the Fed over-tightened and will have to cut rates later.
And that blog also compared the risk-reward of stocks versus bonds right now.
Yeah, they argued the extra compensation you get for equity risk over safe treasury bonds was at its lowest since right before the 07-08 crisis. Figure 26 shows this.
Implying bonds might be the better buy from a risk-adjusted perspective.
That was their suggestion, yes. Bonds looked relatively more attractive at that point based on that specific measure.
Okay, so we've got these two strong opposing views. Dudley Summers bearish on bonds, Shulman Rosenberg bullish. But the report also mentions a more complex scenario, maybe like the 1970s.
That's right. It raises the possibility that we might see rates fall initially, maybe as inflation eases a bit, but then they could surge again later, like in the 70s when inflation proved really persistent.
A head fake, almost.
Could be. Figure 27 compares the inflation patterns. It's a reminder that things aren't always straightforward. History rhymes, but doesn't repeat exactly.
Speaking of history, what about bond performance during that long bear market from the 50s to 81, when rates were generally rising?
Surprisingly, the report notes nominal total returns on bonds were often positive during that period, even some double-digit return years.
Despite rising rates.
Yeah. It shows that, like equities, bonds can reward patient investors over the long haul, even in tough interest rate environments. It's a bit counterintuitive.
But more recently, the trend has been pretty rough for bonds.
Extremely rough. As of August last year, 10-year Treasury total returns had been negative for 3 years in a row. First time ever in data going back to 1928.
Wow. Unprecedented.
It really highlights the challenge bond investors have faced recently. Even safe assets aren't always safe from losses.
So the report tries to blend these bearish and bullish arguments into this unappealing view. What's that synthesis?
Basically, it considers, what if Dudley and Summers are right and bond prices fall further? But what if that happens alongside pricey U.S. stocks also falling, maybe due to a slowdown?
A lose-lose scenario almost.
Potentially. And it questions if even alternatives like value stocks or emerging markets could hold up if rates keep rising relentlessly. The big question it raises is, when will real interest rates finally turn positive? That's key.
And what's the report's bottom line on stocks versus bonds right now?
Well, it acknowledges that back in 2020, with yields near zero, stocks were the obvious choice. Now, it suggests treasuries are unlikely to badly underperform stocks in the immediate future, say 6 months or so.
But longer term?
Longer term, the report still leans towards equities over bonds, mainly because of those persistent U.S. deficits and the likelihood of more Fed money printing eventually, which tends to favor stocks over time.
Okay. Then there's a brief mention of Brazil, Patrick McKim's view, something about déjà vu.
Yeah, McKim draws parallels between Brazil now and the early 2000s. Suggests maybe another period of strong growth is coming, perhaps commodity-driven, making Brazilian assets, stocks, and now bonds too potentially attractive for diversification.
Interesting. And finally, that caution from Leon Levy about market delusions, but also risks in holding only safe assets.
Right. It's a reminder about balance. Don't assume your stocks won't fall in a crash, but also recognize that even cash, bonds, or gold carry risks like potential government actions or expropriation. Diversification and awareness of all risks are key.
So after wading through all that, quite complex analysis, we're here at the outro. It's definitely a nuanced, often conflicting picture for stocks and bonds.
It certainly is. You've got that central tension, right? The bearish case for bonds, inflation, Fed policy, deficits pushing yields up, versus the bullish case, global recession fears, maybe falling inflation expectations, historical patterns suggesting bonds might rally after losses. It's a real puzzle for investors.
And clearly, massive risks and uncertainties all around, reflected in that wide range of expert views and conflicting data points.
Exactly. The potential for bonds to fall further if inflation stays hot and Fed stays hawkish, but also the potential for a rally if we get a sharp downturn and a flight to safety. Even history offers conflicting lessons, like those positive returns during the 50s, 80s rate hikes. It's complex.
So given all these conflicting signals, the historical precedents, the expert disagreements, the final thought we want to leave our listeners with is this. What single factor do you find most compelling right now when deciding how to balance stocks and bonds in this climate?
Yeah, what's driving your thinking?
We really encourage everyone listening to revisit the data, think through the arguments we've discussed, and really form your own informed perspective on the most likely path forward.
Absolutely. It's a time that really demands careful thought about your own risk tolerance, your goals, and how you weigh these powerful opposing economic forces at play in the market today.